have the honor to introduce our next keynote speaker, who's no stranger to the Mojo Loop keynote speaking, Director Michael Eganza, who is the Director of Banking and Payment Services at the Central Bank of Kenya. He holds a master's degree in business administration, over 20 years of banking experience, and I have the list here, but I would just say, while you're already have, in every part of the bank, at a number of INM and Standard Charter, as well as actually one of our greatest keynote speakers the last time we were here in Nairobi, when we all talk about great experiences across the world that countries have with instant payments over the past 5 years. And last time you were here, you did a great job of saying, yeah, and look what Kenya has done over the past 15 years. And so I hope you can follow up to that. Thank you, Mike.
Okay, I think good morning, everyone. So I don't have a speech, but I have a presentation. And there's a reason why I decided to do a presentation rather than a speech, because I struggled writing a speech, because I was like, what do I tell you? I can't squeeze everything we've done and what we are doing in a speech. So I would rather that I try and share our Kenyan digital payments journey. And I'm sharing this in the lens of us as a regulator, as a central bank, from inside out. How do we look at the payments landscape in Kenya? What are the opportunities? What are we seeing? And from the data insights that we have. So first of all, let me welcome you to Nairobi. I think this is the second time the Moja Loop community is coming to Nairobi. So you feel most welcome. But also, I think I would want to recognize my central bankers. I know you mentioned them. I think where they are. Can you just please raise your hands up so that I can acknowledge you? Okay. Please welcome to Nairobi and thank you for coming. But also, the reason why I asked them to raise their hands, so that in case you have a very difficult question that is directed to me, I can know where to seek help and redirect the question, because I think as central bankers, we always tend to think alike. So thank you so much for coming and welcome to Nairobi. I think in terms of just the landscape, where do we draw our mandate in terms of payments? And I think the Central Bank Act, the Constitution, the Central Bank Act, and the National Payment Systems Act is what gives us our mandate as a regulator in the payment space. So we have that legal mandate that anchors our ability to be able to oversight the payment space. So I'll try and run through this as fast as possible. But even as we draw our mandate from the legal payments, from the legal instruments and the regulatory framework from the legal instruments, we do have our policy paper. This is the National Payment System Strategy that we did launch in 2022. It kind of sets out the vision of what we want to be able to achieve in the payment space as a country. And it's really anchored around those 5 principles of trust, security, usefulness, choice, and innovation. And I always make the case that from a central bank perspective, every time we try and look at any issue or any development in the payment space, whether it's a new product, whether we are licensing a new payment service provider, or whether we are having conversations around instant payment systems, we look at it in the lens of those 4 key principles. How is it delivering on trust? How is it delivering on security? How is it delivering on usefulness? And usefulness is very important because we always believe that it's not about the technology, it's the problem and the solution it solves, but also the choice. And choice is very, very important because with choice, then we are able to promote competition and innovation. So that really is the anchor of our policy document. So everything we do in the last 5 years, I know it's coming to an end this year. As I do my KPIs in the office with my bosses, they are asking me, how have we delivered? But also I need to come back to the stakeholders and have a conversation in terms of what have we done? Have we met what we wanted to do? Or there's still room for us to do more? Okay, so in terms of the payments ecosystem and in Kenya, and I'm glad to note that we have various people represented in the room, both from this particular community. It's quite diverse. We have main players that are financial institutions, payment service providers, fintechs, and government. Very central. And the pillars of our ecosystems are really driven by the fact that we have a very vibrant fintech community, but also that are active and also established players. But also access to risk capital is very, very important. How then do they, how are they able to scale? And you can't scale if you don't have access to risk capital. But also the political support that manifests in the kind of policy initiatives that we drive is so central in ensuring that the payments ecosystem and landscape develops in this particular country. And all this payment ecosystem integrates itself. But access to talent, I mean, we pride ourselves as being the Silicon Valley. Silicon, we call ourselves what? Savannah Silicon Valley. So very, very important. And collaboration and having a conducive environment. I think these are the key elements that really have shaped our payments landscape. And that's why we feel we are on the right path. We do collaborate with other key stakeholders and other co-regulators in overseeing this particular space. The Communications Authority, why? Because we are very heavy with mobile money, Competition Authority, the Financial Reporting Centers, and many others. So how we oversight the space is very collaborative in nature. Now, in terms of the payment journey, the evolution journey, I mean, we always say that we started way back in terms of how we modernize and how we modernized our payments ecosystem. And we trace this back in 1989, where the first revolution was around ATMs and how you can draw money from an ATM. It was quite a revolutionary back then. But I would want to focus, a lot of that journey has evolved around two main principles: how we modernize the infrastructure, but also on the softer side, how we build the regulatory frameworks that support the modernization of that. But I'll focus on the last three. What have we been doing lately? So the journey starts in 1989 all the way. In the last 3 years, a couple of things we've done, which I think is extremely important. The latest one that I couldn't be able to have time to put it in this particular chart is that on Wednesday last week, we enacted our Virtual Assets Services Payments Act, an act that allows us to be able to regulate and license virtual asset service providers. A very, very monumental shift in terms of how we regulate virtual assets in this particular space is something that happened last week, part of our journey in developing this particular area. What have we also done in this particular space is that last year, as part of transitioning into ISO, and why ISO becomes very important, the community migrated, that is the financial institutions, migrated to the new ISO standards. So our ISO adoption from a financial institutions perspective in Kenya is almost at 90%. That becomes very, very important because when we talk about how then do we provide common harmonized standards that allow us to be able to interoperate, even when you talk about instant payment systems, how do we interlink our instant payment systems? They have to operate from a common standard. And this is something that we are very, very close up. All the instant payment switches that we have, PesaLink, I think is on ISO standard, our clearing houses, but also our RTGS system. Something that we also did in 2023 is that we did launch our national QR standard. So as part of our effort to try and drive merchants accepting digital payments, we thought that if we have a QR, and this has worked very well in Southeast Asia, we said, how then do we continue to promote merchants' acceptance of digital payments? And how then do we work with the community to ensure that we have a form factor that is affordable, that allows merchants to be able to accept digital payments? And it kind of zeroed around the issues of, do we need to have a QR? And what are the opportunities that a QR standard presents to us? And we did roll out that. It hasn't been as successful as we would have wanted, and the uptake has not been where we wanted it to be because of a couple of issues that we need to be able to address with the industry. But that generally just kind of gives you the journey of where we are and what we've done so far. In terms of the system, that's how we are structured. We have the large value payments, the retail payments. How we see it from an infrastructure perspective, there are those ones that are owned and operated by CBK, where we have the RTGS and the central depository system, which we use to settle our securities, security transactions, government securities. We have the regional payment systems that we operate within the region. Some of them operated within the EAC. And we have the retail payment space that covers the mobile money systems, the SEH, the payment switches, gateways and aggregators, and cards. And I think this is just from a policy perspective. How does everything come together? So we have a policy team, and we have a team that looks at the payment systems operations, licensing and authorization, and the oversight. So this is what forms our national payment system. So the regulatory side, but also how we run the infrastructures that we operate. Very important, if you're operating in the payment space in Kenya, so where do you fall? What kind of license categories do you have, or do we have? So we have payment service providers that are listed there, the various services that you offer. That would range from, payment initiation service providers. But I think very important that is enabled there, you see the elements of having virtual asset wallet providers, stablecoin issuers, and virtual wallet gateway providers. So all these are new categories that will have come in force upon the enactment of the bill. But importantly, all those are the various payment services that we regulate at the central bank. So if you fall under any of that category, then you are licensed by the central bank. And that is just the licensing process. How long it takes, the steps. I won't go through the details, but I think this is the most contentious issue I face with applicants in terms of how long it takes to license, why does it take too long, why can't it be shorter, can we have transparency? But in terms of how then we take through the license process, that's the license process, the licensing stages. But from a regulator's perspective, what are some of the challenges that we see when we are looking at applications? Definitely, the issues around incomplete applications is very, very common. And my co-regulators here will attest to that. Manual processing, yes, we haven't automated the process, so we sometimes end up dealing with a lot of paper-based applications and legal framework limitations. So as the payment spaces evolve, we've realized that sometimes we struggle to fit. Everybody comes with a very unique proposition. So we look at the legal framework and say, where do we fit this? And sometimes it becomes a challenge. And therefore, it is a challenge on our side that we need to be able to address. Issues around proliferation of PSPs is also very important. And when I talk about proliferation of PSPs, what I see is that from our lens, there's a lot of duplication. So I give an example, which is a true example, is that I have 700 applications that are pending for people wanting to be licensed as a PSP. When we look at those applications, almost everybody wants to do the same thing. And I'm asking ourselves, how will they be able to compete? Is there really value? So how then do you assess that? So it's one of the key challenges that we face. So in terms of the whole ecosystem, so we have 121 licensed PSPs. 52 of these are bank institutions, and 69 of these are non-banks, all providing various payment services in this country. Now, once we license, I think the next thing is how do we oversight these particular entities? So oversight is just trying to make sure that whoever is operating in this particular space is playing by the same rules, and our intention is also to be able to ensure that they operate and provide secure and safe payment services and solutions. So our oversight journey, or how we supervise these particular entities, is based on continuous off-site monitoring. So we do a lot of off-site surveillance where we look at what they're doing, the media reports, social media reports. We go into their websites. We also do on-site inspections. We take supervisory actions and have meetings with them. We have communications where necessary, where we have to communicate. But it all ranges alongside those. But what do I see as the biggest challenge, especially in this particular space when I oversight this? And a lot of this I see it from the lens of what I would call non-bank PSPs, or non-bank financial institutions who operate in the payment space. The biggest challenge is around weak governance and internal controls, especially for fintechs. It's the biggest concerns. It's not the sophisticated issues. It usually comes back to the basic issues around governance. Are they structured well? Are they doing the right things? Financial solvency is a big, big issue. I've always wondered how fintechs are able to survive, because all the returns I see, they declare losses. I don't know whether that's the nature, but somehow they're in business. So as a regulator, from a prudential perspective, I get concerned around issues of financial solvency. Then definitely issues around non-standardized reporting. Now, a lot of this issue when I talk about non-standardized, so for example, when it comes to issues of IT security and IT platforms and resilience around this, the issue is that the way the law, and probably something that we need to be able to do even as we move into what I call a risk-based oversight, demands similar standards. It doesn't, so there are no standards that are given based on the size of the institution. So you find that for the smaller institutions, sometimes it becomes such a huge burden to be able to comply. So I think the questions that we've been asking ourselves internally is that how do we have a risk-based oversight approach where we have proportionate requirements depending also on the size of the institutions, but making sure that we have a minimum standard that has to be applied by everybody. But I think increasingly, the biggest concern comes into the area of weak consumer protection, how consumers are protected, but more importantly, depositor protections. For those payment services that receive public funds, what kind of safeguards do they have in place to ensure that consumer protection depositor protection is guaranteed, that customers' money are safeguarded, and that becomes a focus of our oversight activity. I think in terms of the system, so we run the KEPS, which is a multi-currency system. That is our RTGS system. It clears in USD, Kenya shillings, euro, the major currencies. Our ACH that we operate on behalf of the Bankers Association. And we have the regional payment systems there that are multi-currency, settled in local currencies. And we've had this since 2014, where those are the countries that participate in our IPS system, but also in our REPS system. Those are the countries that participate. So it allows us to be able to settle in local currency within the region. For IPS, REPS settles in hard currency, that is in dollars and euros, but for those particular countries. But they are large value payment systems, not instant in nature, but allow us to be able to settle. But a lot of our local clearing domestically, but also cross-border, for the large value system runs on Swift rails. So in terms of the data, and this becomes very important for you to be able to appreciate what we see from the data. So it kind of just gives you a synopsis of where we are. So mobile money is definitely, as you see in the subsequent slide, is the most predominant payment method that is used in the country. In terms of active mobile money accounts, that's 36.9 million active mobile money accounts from a population of around 55 million. This is on a 30-day average. Merchants, mobile money merchants, that is 710,000. These are the ones that are active. If you look at the active and dormant, is in excess of 1 million active merchants that we have. The point of sales, I think that's 48,000, very low point of sales if you compare to Nigeria, where they have in excess of 1 million point of sales terminals. So we have very low, but the ATM network, similar to that. So I think it's just a snapshot of some of the statistics that we do. But we were trying to look at it, and this is had conversations with Visa around this. So we were trying to look at, and this is Visa's information, really to look at how is the adoption of digital payments in Kenya, and comparing this with other peer countries to say, if I was to do a comparison with other countries, where are we in terms of adoption as a percentage of the population? And how are we doing in terms of what I'll call other countries? So 64% of our population uses digital or payment transactions, or have access to digital payments transactions. Now, all the adoption of digital payments transactions. So is this where we need to be? I'm not so sure. Yeah? Is this the right number? Maybe you will respond, but I think it should be higher. But according to this, then we are at 64%. And what does that then mean? Okay? So we're looking at some data to ask ourselves, year on year, what have we seen in terms of growth of digital transactions? Now, and we've seen a tremendous growth of digital transactions across various payment methods. So for example, if you look at the chart on the far right, it's far left on my side because I'm looking at this, I think far right for you. So the growth, and this is on growth between so we're looking at the numbers between 2020 and 2024 in terms of mobile activity. This is mobile money activity. We have seen a 187% growth. So year on year, the volume has continued to grow. Yeah. If you look at the large value transactions, the activity we see in KEPS, we've seen a 64% growth. We've also seen a 45% growth in our clearinghouse, that is the ACH, this is the EFT, and a marginal decline in the volume of checks by 5% in the last 5 years. We still have people who still issue checks, and I think in subsequent slides you'll see it further down, but also a very marginal growth in terms of cards. But in the last year, the card activity has actually come down, and this is in the retail payment space. But overall, you will see that increasingly, year on year, we are seeing higher adoption of using digital payments, whether they are instant or not, in the economy. And I think this is a slide we were looking at it and asking ourselves, from a maturity adoption, where would we place ourselves? So are we in transition, or are we fully electronic? And it's a very interesting chart. So in terms of comparing where we are and where other jurisdictions are, what have we been able to do? Yeah? And we fall into the category of being in transition. So where transition basically means that, yes, we have adapted electronic modes of payments, but there are still elements of friction that we need to be able to address for us to be fully electronic. So we are in that journey of transitioning. So we are not cash-centric, definitely not. We are not resisting, but we are in transition. And I think that recognizes some of the friction that we need to be able to address to really move to fully electronic. Now, I think this chart becomes very important because if we look at the retail payments activity in the country, because it gives you a lens of what we see. So 99.9% of the retail payment, 99.4% of the retail payment activity in this particular country is done on the mobile money rails. Now, payments being an activity business, it means that if you're not in mobile money in this particular jurisdiction, then as a business or as a fintech, you're missing it. Why? Because it's a fully dominant mobile. It does come with its own risks, but it's a fully dominant rail. So, I mean, cards way down there, EFTs way down there, checks still issued 0.1%, though the value is at 3%, while KEPS has a very low activity, because this is a large value payment system, the value goes up. Now, mobile money being the most dominant rate, we try to do a further deep dive to look at what exactly do we see in terms of mobile money and what exactly are the opportunities and the risks that we see. It's undoubted to say mobile money has really been at the center of our success in financial inclusion. It's the one that has driven our financial inclusion numbers and financial access to where it is as a country right now, from a low of 27% in 2006 to 85% in 2024. A lot of that financial inclusion metrics has been driven around mobile money and the penetration of mobile money. Okay? And therefore, if you look at mobile money, what exactly are we saying? Yeah. So currently, if you look at the activity, very interesting thing that we see in terms of mobile money. Currently, 18 million unique Kenyans transact or do a mobile money activity every day. 18 million. So that's me, someone else. And it's projected to be 26 million in the next 3 years. So that just shows you how ubiquitous mobile money is. So individual unique customers do mobile money activity in this particular country every day. And definitely the fact that it has moved from the old P2P, send money home, now we see adoption of various use cases for mobile money, merchant payments, insurance, they provide, pensions, CIS schemes that are unit investment schemes. All that has come into the mobile money. The services that have been built around mobile money have also helped accelerate the usage of mobile money activities in the country. So I think this is just from a gender divide perspective. We don't see much in terms of male and female. So all almost using the same equally, 99, 96%. So really we don't have a huge gender divide in terms of mobile money adoption. Now, I think here is a very interesting slide. And the reason why we decided to do a deep dive on mobile money is because of that 99%. Now, what this slide seems to tell us is that how does money enter into the mobile money ecosystem? And how does then the money leave the mobile money ecosystem? So if you look at 2024, I think the cash in, so this is how money then is translated into e-money, is that I go to an agent and I give them cash and then they convert it into e-money. In 2020, Yeah, the cash in was 3.23 trillion Kenya shillings. Out of that, the 1.98 was cashed out. Yeah, so the cash out rate was very high. But we've seen that widen. In 2024, we had 6 trillion cash in. This is at mobile money cash agents. Out of that, we had 2.6 that was cashed out. So it means more money is now remaining within the mobile money ecosystem. So it means the adoption of digital payments and the usage within the ecosystem is becoming more stickier. But that notwithstanding, we still have 2.66 trillion being cashed out. And we were asking ourselves, why then do we have money being cashed out? Yeah? And we've done some of our own studies. It really boils down to 3 issues. Yeah. A lot of that was issues around cost. And you'll get to see it, that especially for people below the pyramid, it becomes extremely expensive for them to transact digitally. So the cheapest option is to cash out and transact in cash. The other thing was, and this is part of the things we see, money, cash still has very unique properties that digital payments don't offer. One was the issue of anonymity, and second, it's instant. So those are some of the key considerations why we still have such a big number. But the highest consideration was the issue of cost. Okay? I think that is just volumes, so I'll skip that. I think these are the other retail payment rails. I think the most critical one is the issue of checks. And we've really struggled to understand why checks don't disappear. Yeah? There are dinosaurs that still use checks and prefer checks. But when we delved in the numbers, we realized that a lot of the usage of checks is with SMEs. And SMEs still prefer issuing checks, and they use them as a working capital tool. And therefore, it solves for them a problem that hasn't yet been solved by the bigger financial institutions. So it becomes very, very hard for us to really say we will get rid of checks, even as we provide other more efficient modes of payment. It still has remained sticky. It comes down, but we still have people that issue checks. Definitely cards is where we still have a challenge. The adoption has been very low. And a lot of the issues around card, when you talk to merchants, really rest around the issue of settlement, time. It's not instant, and therefore it doesn't work for merchants. The cost associated to cards, the MDRs, that are at 1.5%, so it becomes very expensive for merchants to be able to do that. And merchants then decide what mode of payment to use. I think the large value payment system, that has continued to grow, and it's mainly for the large value, interbank and a lot of the cross-border, we see activity there. I think this is a chart that shows just our activity within the region, and this becomes very important. As an integrated region, we've seen a lot of growth of activity within the corridors within the EAC, a lot of transactions that go there. The most active corridor is between Kenya and Uganda, and this is from the IPS data. A lot of transactions and payments in the digital rail happen between those 2 corridors, and Kenya and Tanzania. I think this is how do we track the cash displacement, and really asking ourselves, are we making progress in terms of digitizing the economy? And I think this is a metric that we try to use to see over time as the economy grows, are we having less usage of or less need to print cash? So cash in circulation as a percentage of GDP has been coming down. 2.2, this is for 2024. Last month's numbers were 2.1%. That is cash in circulation as a percentage of GDP. If you look at the metric that looks at cash outside banks, so because this includes the cash that also sits in bank vaults, if you look at the number for cash that is outside banks, it further comes down to 1.8%. So it clearly tells you that we are doing very well. And for you to see that is then you have to compare it relative to other countries. How are we doing in the region? And that tells you how digitized the economy is and how we are doing very well. So, I mean, I always joke with my colleagues from India who talk about UPI and how UPI has done miracles for them. But I tell them that they don't beat us. We still have a higher per capita usage of digital payments that are instant than UPI on a per capita basis. So we have done extremely, extremely well. So I think this is just the extent to how the economy is digitized. So it just looks at the various metrics. I think in a nutshell, the slide looks very busy, that we have done extremely well compared to other countries in terms of our metrics, looking at various parameters, and over the years, we have a highly digitized economy. I think this is just numbers that show what are we seeing in the payment space. Very important is government payments. 2.5 trillion of payments activity happens in government rails. That's quite significant given our size of the economy. I think for the business development people, if you want to be in the payment space, you have to find ways of doing business with government because they either disperse a lot of payments or through the collections. Very important. But also what we see a lot is remittances, and a lot of these are diaspora remittances, so we've seen a growth in that. What remains a major concern from our numbers is the cost of remittances. Still very high. So the average ticket size of a remittance coming to the country is $80. And out of that, it still costs 8% of that goes to fees. And a lot of that fees and commission is loaded on the FX exchange. So that is still a major concern in terms of how do we reduce the cost of remittances, especially the cost of doing these transactions. For an average ticket size of $80, 8% of that is extremely expensive. I think what is this? Okay. I'm lost. Okay. Maybe it's because of instant payment performance. So we were also looking at it because we've always had this argument internally within the CBK. Do we have an instant payments with all this transition to instant payments and instant payment solutions? Do we have an instant payments problem? And our own assessment, we don't have an instant payment problem because mobile money in itself ticks all the parameters of what an instant payment should be. So 99.4 of our payments are instant in nature. So when we've talked about instant payment systems and fast payment systems, so we've always asked ourselves, so what exactly are we trying to solve? Are we trying to solve a fast payment problem, or that problem has already been solved? What exactly are we trying to address? Because if you look at the numbers, really, 99% of our payments are instant. And from a policy objective context, so which are the nature of payments that then we need to be able to focus on to transition them to instant payments? It's the issues around the activity that goes on to checks, EFTs, and those are part of the 0.6% that are not instant. So what exactly then do we need to be able to do? So if I look at then what exactly then do I need to be able to do? If I look at what mobile money does, what account-to-account activity happens through an instant payment switch like PesaLink, you find that that further pushes it up to almost 99.6%. So it's only 0.4% that we need to be able to solve. But the problem is in the structure of how that payments, that the instant payments have been done. And we've looked at that and we say there's still a challenge. As much as we have instant payments, there's significant friction, and that friction is what contributes to the challenges we have around costs and cost around digital payments. Because we see that manifesting itself in the cost of digital payments. Because the way the ecosystem has been structured, every time you move money, there's a charge associated to that. So we've been asking ourselves from a policy perspective, how do we address this issue? And it still comes back to the issue of, can we have a shared infrastructure? Yeah. And what does a shared infrastructure mean? How can we move from private rails to public rails? To be able to provide an infrastructure that everybody can use to leverage on, but also how do we have an infrastructure that is more open and multilateral? And that becomes a very, very key concern, because the way the architecture is right now, it struggles to meet those two things. One, we have a situation where we don't share infrastructure, everybody seems to do their own thing, and two, our platforms are not open and multilateral. And that is a concern. And we feel that there's an opportunity for us to be able to do that. And in terms of limited infrastructure sharing, I mean, it's clearly evident. You see it everywhere. The evidence is there. You go to the merchant, he has 5 POS machines. You go to the malls, there are 6 ATMs, everybody there with an ATM. But it shouldn't be like that. It can be better. And if that is addressed, then it translates to much more affordability to the end user. Yeah? Interoperability is a major concern, yeah, for us from a regulator perspective, where a lot of the interoperability we have in country is built on bilateral rails. And that, we think, is part of the challenge. And how then do we have open multilateral systems that would be able to address these challenges we have around interoperability? Okay, I'm not sure. Okay. That's interesting. So I think, this is just an illustration on cost. And it's a very interesting thing that we did. We tried to look at how much does it cost for someone who's at below the pyramid, because we try and look at this to assess affordability. And for someone who's earning 25,000 Kenya shillings, that's equivalent to how much? Let's say $200 a month. 2%, if they chose to fully operate digitally, 2% of their income will go to charges. 2%. And that is very, very high. Yeah? It further just illustrates the challenge that we face. And we feel that that challenge is contributed by the frictions that we have explained up there. The issues around open multilateral platforms that exist because of the bilateral arrangements, the lack of shared infrastructure, etc. So I think the other thing, and maybe this is a sideshow, but I think important, even as we have an instant payments platform, one of the major issues that we've seen that is of a major concern from a regulatory perspective for us is that the more instant payments we have, we've seen a fraud epidemic. And that fraud epidemic is so monumental that year to date, that this is the numbers up to August, we've had 200,000 incidences of actual frauds that have succeeded, and Kenyans have lost around 819 million shillings through social engineering. Yeah? And that continues to happen, which is a major, major concern. So while we see the opportunities around instant payments, the risks further manifest, and the risk that we are seeing is the fraud epidemic, how through social engineering, and how people get defrauded because of how fast money moves. And that is a concern from a regulatory perspective. Lastly, I think the last, if I further, it's not moving. So Not so sure. Yeah. So I think as I conclude, really, this is part of the lessons learned from us as we continue to look at this is really customer centricity becomes very important. And that is informed, the issues around consumer protection, customer centricity, increasingly in this space where we are moving to faster payments, instant payments, becomes very central. How do we ensure that we, even as we design the flows, we take the customer into account and we protect them? But also, the usefulness of the technology is very important. Sometimes we have placed a lot of emphasis on technology and not the solution, and I've seen a lot of that happen, where people come and pitch for their licenses, and the focus is that, oh, it's being built on chain and all that, but then you really struggle to understand what are they trying to solve. Becomes a huge challenge. Country context is important. We've learned this, that sometimes you can't replicate solutions from one jurisdiction to another. It just, you really need to take into account the country context. And consumer protection, I've talked about that, is very important. And I think the need for regulators to be able to collaborate and work with the industry is important. And lastly, it's really not about institutions, it's about the ecosystems. So I will beg to stop there and hand it back.
Was there anybody else who, during Michael's presentation, just wanted to comment on every single slide and wanted to raise their hand and be like, I've got an idea on that, I've got an idea about it. Or the number of you who, when he was speaking, I said, can you please talk to Liberia about that? Can you please talk to Bangladesh about that? Can you please? So I very much hope that everyone took great notes. I'll go through the slides and I'll try to send out my comments. But a couple of points I wanted to mention of the point that may have gotten some applause of this, the comparisons, and we're here in the world of instant inclusive payment systems. We all know people are often talking about UPI and PIX. And I really want to mention something. For those of you who know, I recently moved my family from India after 6 years to Rwanda, and I can say everything that I talked about how much, as a customer, as a citizen, UPI changed the way I transacted. I got to Rwanda and realized that having a dominant mobile money company solved all of my problems as well. And so it means that what Rwanda is trying to solve, what Kenya is trying to solve, what Liberia is trying to solve, what all of you are trying to solve is a very different problem than what India has tried to solve or Brazil has tried to solve. And so that country context comment from Michael, I think, is incredibly valid. And so while I think we can learn a lot from each other, I think it's important to realize how different everyone is. So thank you very much to our speakers once again.